Welcome to the Senior Living 411 series. My name is Desiree King, and I'm the co-founder of Senior Living 411. What we do is we offer an affordable and comprehensive 240-point senior home safety assessment. We will leave you with a written safety survey summary and recommendations. We also offer a simple management service specifically designed for older adults wanting to age safely at home and families who may not be able to ensure the basic safety, security, and upkeep of an aging parent's home. To help protect older adults from elder abuse and financial exploitation, we maintain a vetted network of screened craftsmen to perform any necessary interior or exterior repairs. Our mission is to provide education and resources designed to help people live empowered lives and make informed decisions. Out of this mission was born the Senior Living 411 series. The 411, what does that mean? It's what seniors and their adult children want concerning aging in place, in-home healthcare options, retirement planning, insurance planning, downsizing and decluttering, funeral planning, and so much more. These topics, along with others, are presented in the Senior Living 411 series in the format of 30 to 60-minute educational seminars on Zoom and Facebook Live. And then we also put it on our podcast afterwards. Adults 55 plus, seniors and caregivers are invited to attend the Senior Living 411 series to learn about actual facts about issues related to aging. The series of candid conversations and expert panel discussions about the unique and often complex issues facing families are moderated by myself, Desiree King, or my husband, Alpha King. These discussions allow families to get to know the person behind the profession, thereby creating a safe space to ask questions, learn, and ultimately form proactive relationships so that when a situation arises, you can actually reach out to someone that you can trust. Today's topic is the 411 on long-term care insurance. Now, it's funny because originally when I had the topic, I said for seniors, but long-term care insurance is not just for seniors. So today's topic is the 411 on long-term care insurance. And joining me, I have Mr. Owen Rhoden. Welcome to the show, Owen.
Thank you, Desiree. Happy to be here.
Great. Let me tell you a little bit about Owen before we start getting into the meat and potatoes of the conversation. Owen Rhoden is an independent financial security advisor, and he's been in full-time practice for the past 11 years. Using a client-centered approach, he has helped and continues to help and support clients located primarily in the Greater Toronto area. A highly versatile financial services professional, a proven leader and communicator with over 25 years experience in sales, distribution, marketing, product design and development, and middle management for 3 major Canadian insurance providers. He believes that utilizing focused knowledge, current consumer trends, a passion for his work and his clients as key enables in a service lead environment and can transform personal objectives from surviving to thriving. Dubbed the Road Warrior, he has organized many trade shows across Canada and the USA where he delivered presentations on sales and marketing strategies to other financial advisors. Presentation venues have included the Independent Financial Brokers of Canada Summit, Peel Institute and Pro seminars. Now, some of his prior roles in the industry include Senior Business Development Manager, Executive Accounts Director, and Product Marketing Manager. And in addition to his current practice, he regularly consults with advisors who are looking for unique ways to use product features and strategies to enhance their client experiences. Owen's work has been featured several times in industry magazines like the Insurance Journal and on Canada Newswire. He's a member of the IFB, which is the Independent Financial Brokers Association of Canada. He's currently the president and interim chair of the Lions Circle African Canadian Men's Association. And here's an interesting fact. In October of 2017, Owen represented Canada as a member of the National Dragon Boat team and competed at the World Dragon Boat Competition in Kunming, China. He returned to Canada with 6 podium finishes, including 2 gold medals. He has a love for life, water, cycling, competition, and helping his clients to achieve their maximum success. He's trustworthy, he's passionate, he's charismatic, And Owen is also working in the best interest of his clients, helping to find the right solutions for his clients' ever-changing financial security needs. Owen is one of my resource members in my team, and he's also someone I'm proud to say is a friend of the family. Welcome again, Owen. Glad to have you here. Awesome. We're going to have a great discussion tonight. Looking forward to it.
Thank you, Desiree. Again,
Oh,
I'm happy to be here.
awesome. Awesome. So, Owen, my first question to everybody is tell me your story. What was your path towards becoming an getting involved in the financial sector and getting involved in insurance?
Okay, well, my path was, it started when I came to Canada as a teenager. I remember coming on a Friday, having a conversation with my mom, and my mother said, look, you got to find a job. Now, I'll back it up a little bit, where in high school, I jokingly said I was going to become an insurance agent. Well, as they say, be careful what you wish for, because you might just get it. And so about 5 weeks later, I started my career at my first insurance company, where I spent 10 years. During that time, or the latter part of those 10 years, I was asked to get licensed. So there are two levels, level 1, level 2. I was asked to get licensed. I began that process. Then when I switched over to the second company, which I worked for 3 years, and I got my level 2 license and was challenged to start some kind of production or practicing in the area of insurance. And so did that. After 3 years, the company got bought out by another insurance company, and I went into practice for myself for a year and a half, almost 2 years, and then went back into working for the third insurance company for about 6-7 years, and after which then I went into full-time practice. So that's the short and sweet story. It's something that I think I was destined to do.
And I think it's a great thing. We often discuss on this show when your passion actually aligns with your career.
Yes.
Because then you're able to deliver that peak performance and peak genuine service in what it is doing.
Absolutely.
Definitely. And your story is familiar to mine. My mother was the same way, get a job. And you had to figure out, do something, because in our household, you better come back home with a job. That was back in the days when you could get a job, leave and come back actually. So
yeah,
definitely.
Sure.
So I know there's a wide variety of insurance. Insurance is such a broad term, but just for the purpose of today's conversation, I really want to just go right in on long-term care insurance. Can you please give us the definition? What is long-term care insurance?
Okay. So long-term care insurance is insurance that the public can purchase individually, right? So I know that some companies, they offer it as well, but let's talk about the individual long-term care. They purchase that to help them to pay for their expenses when they're unable to perform what is called the activities of daily living. So, for example, if they're unable to toilet themselves, if they're suffering from incontinence, bathing, dressing, etc., or if they require the help, substantial help of instruments. So what is known as instrumental activities of daily living. If they're unable to perform some or all of those, then the insurance will pay them an income style benefit so that they can pay for it themselves. They can pay for their care. The care can happen in home or in facility. It can be, as I mentioned before, income style, or it can be a reimbursement style. So it's pretty broad. So, yeah.
Wow. So just delving into that now, and like you mentioned so many different things which we're going to touch on today, but someone say in their 40s yet who hasn't yet reached a state of needing the insurance yet, should you consider factors like your wealth. Can you afford this? If you're wealthy enough, do you need to get this? Or should you consider your family history of diseases when making a decision whether or not to get it?
Okay, so yes, yes, and yes, all should be considered. So let's talk about the quote unquote wealthy. We do know that the threshold, the bar for who's considered wealthy is actually moving. Not so long ago, $1 million of net worth would make you wealthy. These days, you better have somewhere north of 5+ million in order to be considered wealthy, right? So for the wealthy, though, they have an issue of retirement and tax planning. They want to retire in comfort and dignity, or with dignity, but they also want to make sure that they minimize their taxes and preserve their estate. So for those who are wealthy, the smart thing to do is to at least explore, possibly if they don't want to pay for it all, then do a shared arrangement where they buy some, pay for some of their expenses, and then let insurance take care of the rest. For that 40-year-old that you mentioned, it is the best time, I think, to seek about buying this type of insurance. The threshold, the bar for qualification is pretty high. Some 50% of people don't qualify for the standard product. I say standard product because there is a simplified issue product that is also available, but it is pretty high. It is a living benefit, and as you can imagine, the insurance company wants to make sure that only the well qualified will get their best product and service. Okay.
So what is well qualified?
As in you don't have a lot of the non-communicable issues that pop up with age. So you're not diabetic, for example. You haven't had a stroke, or you're not recovering from a stroke, cancer. Those are some of the key things.
So you're saying the best time is while you're healthy.
The best time is while you're healthy. A particular company may have a target market that is different, right? So for example, one company will say their target market is between ages 50 and age 70. But that's not reality for certain groups like ours, right? For our groups, we have a greater proportion of our people who are contracting these non-communicable diseases earlier, and therefore disqualifying us from getting the standard product at the best rate. You want the best rate, you want the best product, start early. It's cheaper too.
So is that then to say that if you do have a pre-existing condition, you can still get insurance, but it'll cost you more, and it won't be from any company? Is that what kind of like deciphering that?
So it is possible, depending on what the pre-existing condition is. Okay, I'll give you an example. If you're hypertensive, for example, and your hypertension is well controlled, right? And the threshold is for one company. I'll give you an example. If you're recording systolic of 174, diastolic of 90, right? Then you're fine, or below is fine. Anything above that, you're going to be a decline. Okay, yeah. So that's just one example of a condition that you could get it, or you may not, depending on the reading. Yes.
So does it matter what age you are for them to do a medical, or is it something that just happens? Everyone gets a physical, or is it like after a certain age they figure you need to get a physical?
Yeah. So definitely after the age of 70, you will need to provide medical records. Before the age of 50, more than likely all that you need to provide is an application form. So any further inquiry that arises from the application form will depend on what you put on the application form, what you disclose.
Okay. Wow. And what happens if you don't have the insurance? Like what are you looking at? And then something happens, life happens.
If you don't have long-term care insurance, then what I recommend to my clients or anyone who is listening is that you put together what I call a sinking fund. So you put aside some of your monies to take care of you when you're older.
Wow.
That's yeah. Well, if you live, you're gonna get old. If you get older, you are very likely to become sick
Yeah.
or not sick, but unable, right? And so, especially for females, females will live longer than males and are more likely to become unable than males. You see, we just die, right? We just.
When you say when you suffer, you guys die. Like, okay.
But uh, if you're completely unable, which I find that most people, if they do some planning, some proper planning, budgeting, and preparation, mental and emotional and financial preparation for this, they can afford something. You can get as little as $100, $150, pardon me, per week of benefit, right? It's not much,
Yeah.
but if you add inflation protection to it, an inflation protection rider, then that 150 can grow and become a whole lot more. Okay, so it doesn't mean that you can't afford something. You can do what there is a reimbursement plan that's available out there. So you can say we want a 50,000 or 100,000 reimbursement, and so it takes care of your hospital bills and those that as you're in a facility care or hospital. There are various options out there that make it affordable for just about anyone who can qualify.
You touched on my next question, which is there what is an inflation protection? Just go a little bit more into what that exactly consists of.
For sure. So inflation protection allows you to start with one level of benefit. And I mentioned 150 as my example. And you can pick an inflation protection that grows that 150 benefit while you're not on claim by 2% compounded every single year. Okay? And then when you go on claim, then that 2% switches to 3%. So for every year you're on claim, you're getting your benefit increasing by 3%.
Mm-hmm. Wow. Okay, so that's definitely something. Is that a standard thing that comes with the policy or something you should insist on happening?
I think you should insist, as a consumer, you should insist on two things. One is having inflation protection. Why? Because inflation is a real thing. It is a fact that the money that you spent on a basket of goods last week is going to cost you more for that same basket of goods next week. Okay, so insist on inflation protection, number one. The next is, if at all affordable, buy the return of premium at death benefit. Okay, just in case you are one of the lucky few people who don't become unable.
Hmm.
So this way, upon your death, some or all of your monies that you paid for this coverage goes back to your estate, goes back to your beneficiary, your designated beneficiary. Yeah.
So it's not something that just goes to waste if you don't use it. I was just thinking that as well.
Not at all. Not at all.
And is that something you have to request that as well? It's not natural that that's part of it.
No, it is available.
Okay.
You can definitely request it.
Yeah. Wow. Okay. Wow. That's deep. So, wow. Another question I have is this, is that you said that it can cover in-home care. So if you need like a PSW or whatever coming into the home, also facility care. Now, I know personally from working in the industry that in-home care can be quite costly. Is there a point where the insurance company says, no, you have to go into a facility, you cannot stay at home because it's cheaper for them to pay that out?
Not if you have your own care. If you have your own care, then you dictate, and your family, of course, because you are unable, right? So you and your family can decide where you want your care to occur, right? We've seen what has happened to some of our elderly folks in the long-term care facilities, where some of their family members had to sneak in and kind of kidnap them out of there.
Yeah.
Yes, and care for them at home. And for those who have their own individual plan, that plan continues to pay for them for their care while they're at home. Now, what's important to note is that if you buy your own individual plan, that money is coming to you. You can use it for anything that you like, any which way you like.
And you're saying individual care as opposed to your group plan at work. That's what you're referring to, right?
Yes, that's that too. Yes. So when you buy it on your own, you are in control. Nobody tells you what to do. But if you were to buy, even though you pay for it on your own, but you pay for facility care, only facility care, then that's what you bought. The insurance company is going to pay for you to be in a facility, right? So that's kind of,
you really need to be prepared and know if you were to get ill to a certain point, each step of the way, where do you want to be? Do you want to be at home? Do you want to be in a facility? And make sure that the insurance is respecting and covering your needs then.
Absolutely.
Wow. Okay.
Best bet is to go either or. Go either or. Wherever I choose to go, because if my family cannot take care of me, and I believe that I can get best care in a facility, and I go there, my money follows me.
And that's saying that you have the facility, you pay a standard rate, you have the care there, but now you want to do what's called top-up care, which is have that still personal one-on-one service in the facility that could follow you as well.
Absolutely. Absolutely. As I said, you buy the right plan for you, and the plan will pay you, right? Unless it's a reimbursement plan where you have to pay up front and then it gives you the money back, that's different. But if you've paid for it, and let's say you purchased a $2,300 a week plan, you're getting $2,300 a week. That's it.
And is that does that depend on if you're getting, a lot of people try to maximize, I guess, the LIN care, which is the government care within Ontario, so the local health integrated network. Okay. So we usually tell people in the personal care industry to maximize that first, because once they have that, it saves them on HST in personal care. So does insurance look at if you're getting government care, or that's nothing to do with them? This is what you're getting and this is the coverage you're getting.
Okay. So I think that the term we use is coordination of benefits.
Okay, yes.
So if you're getting the benefit from one party, then the other party won't double up, they'll half it, right? Well, no. When you buy your own plan, the insurance company is not asking if you have any other form of care or payment coming. They don't care. You've paid for it, you get it. Once you qualify, you get it.
Wow. Okay. And sticking on that topic, I guess, is there a period of time that you usually have to wait before your benefits kick in? Or does it say Well, I guess, I don't know, it's hard, like long-term care is such a broad topic. Like I said, it could be, you get in this tragic accident, you need it now, or you see yourself deteriorating as you get older. So there's different phases in that, but is it something that can kick in right away, or is there a waiting period?
Okay, good question. So I'll mention that one can obtain long-term care insurance as young as age 16. You just mentioned, yeah, 16. You just mentioned that this is not really and truly age dependent, this being unable to perform the activities of daily living. We see tragically teenagers who are one bad move and next thing you know, they can't take care of themselves, right? But, sorry, question again.
No, the question, I just went up when you said 16, my mind went, whoa.
I know, it's me too.
Waiting period.
Waiting period, yes, thank you. Yes. So your waiting period, depending on the product, the program that you choose for yourself, can be as little as 0 days. So immediately. If you choose, for example, hospital care, right, or reimbursement plan, as soon as you go into the hospital and you start incurring expenses, you qualify for those reimbursements. No wait. But if you choose another plan, an individual plan, for example, most common would be a 90-day wait. Okay, 90-day wait, unless you're considered palliative. If you're palliative, then there is no wait. You can apply immediately.
Okay. And do you pay more for a plan that just pays directly as opposed to a reimbursement plan?
Yes, you do. Okay. You get what you pay for.
I figured that. Hold on. Why would you choose not to?
You get what you pay for. Not only, yes, you pay more for the individual plan versus the reimbursement, but the reimbursement plan has limitations. So it'll go up to 100, 150,000 reimbursements total lifetime. Okay.
Is there an unlimited plan?
Yes, there is. In fact, not on a reimbursement basis. That has limitations. The most I've seen is 150, but there is an unlimited individual plan that will pay you for as long as you are unable. Okay. And you can add inflation rider, the inflation protection to it, and you can get your return of premium at death on it.
I was coming with that question next, so you just answered. You're reading my mind. I was like, and you can, and you can. So
you bet.
For our listeners, you really need to listen to what Owen is sharing with us today, because so many of us don't know. And one of my favorite saying is, you don't know what you don't know until you know. And even me sitting here processing and hearing, it's hard for me personally to now hear this and not act upon it, because it only makes sense, from what we've talked about so far. We haven't even gone that deep in the discussion yet. But with that now, if someone, say, were to be diagnosed with something like dementia or Parkinson's going further into the future, will they still be covered?
If they have the plan,
yeah,
and the cognitive impairment, it leaves them unable to perform any two out of the 6 activities of daily living or instrumental activities of daily living, then yes, they are definitely covered. That is what the plan is there for.
Now, the activities of daily living are usually covered by a personal support worker. Does this plan also cover nursing care? Because nursing care is quite more expensive, I'm sure you know.
Yes, of course. Of course it is. Yes, it covers any form of care that you want to or need. It even covers travel. Okay. Wow. Yep. It covers it all. Perhaps this is a good time for me to mention that if you have your individual plan and you're unable, so you make a claim, you're collecting, your family's collecting to take care of your needs, and one of the, or any of the items that you have to pay for would be considered deductible under the medical expense non-refundable tax credit, then that plan, that individual plan is eligible. Your payments, even though your payments are tax-free, you can actually claim what you pay for under the medical expense tax credit. Okay. I want to, I must tell you that the reimbursement plan doesn't work the same because you pay first, you get the money back, so you're considered whole. But if you pay for that individual plan and use that money to renovate your home, for example, you have to travel for care, right? Cancer treatment, anything like that, right? Food, someone to be with you all the time, then those are eligible expenses.
I was going to ask about that. Does it cover home renovations? Because again, most homes, as I do the assessments, are not equipped for someone even to just like most doorways aren't even wide enough for a wheelchair to go through, or the bathroom is not equipped for a walk-in as opposed to these tubs. And there's a whole plethora of stuff that we can go through that homes need renovated. So does it cover home renovations as well?
Absolutely, it does. It does. Stair lifts have become quite the thing now for people who want to stay in their homes. And I happen to know firsthand the cost of a stair lift.
Oh yeah, I do too. Expensive.
Yeah, some 10 grand for one of those things, plus annual maintenance, et cetera, et cetera. So yes, most definitely.
And is it something that if you wanted to do home renovations, do you have to submit quotes to say what you want to do as proof of, or how do you go about negotiating that with the company? Like, how does that work?
Okay, so if you have a reimbursement type plan, then there's a whole listing of what's covered and for how much coverage you have for that particular item. Mm-hmm. If you have your own plan, once again, they cut the check, they send it to you, they don't care what you do with it. So renovate away, right? Put in a nice spa if you want. Whatever will make you better, because when you think about it, at that point in time, you're unable to take care of yourself in a serious way, right? Quality of life, dignity becomes paramount.
Yeah, so true, so true. And I can safely say I've seen the worst case scenarios and I've seen the best case scenarios. I remember I went into one family's home. The gentleman was about 96, his wife was about 88. And when I talk about home renovations, they should have been like a display house for it. They had everything down to the tub that just opens and you walk in, but then it could fill up. And they had the stair lifts all over, for the littlest stairs to the biggest. I mean, they were renovated to the T, but they said, we're not leaving this house. So obviously they, what you're saying basically is begin with the end in mind.
Absolutely.
Right? That's actually the phrase to sum this all up, is really begin with the end in mind.
That's right.
Powerful. Now, is a policy like a mortgage? Every 5 years you got to renew and qualify, or is it like a one-time qualification at time of purchase?
Okay, so one-time qualification normally, unless you choose to lapse the policy and play around with it that way, which I strongly don't recommend. After that, though, the premiums are usually priced to be guaranteed for the first 5 years. After the first 5 years, then the difference between companies go this way. I will describe. One company will say, well, if we choose to review our rates, our rates are reviewable. If we review them, we can review them every year. Another company says, if we review our rates after 5 years, then those rates are guaranteed for the next 5 years. Okay, and so on and so forth. So again, it really depends on what type of product, what variation, what permutations you choose, you decide for yourself. My recommendation, if you can afford it at all, is you go short pay. Short pay in the world of long-term care is you pay over 25 years as opposed to paying for life. But yes, all of the plans you're paying for the rest, for life means age 100, by the way. All of them are done by age 100. but your benefit stays and it continues. If you haven't claimed it, it waits for you to claim it. All right?
So why is it 100? People, there are a lot more centurions out here.
No,
Is that possibly? Go ahead.
Your cost stops at age 100.
Okay, got it. Sorry, I thought they just cut you off at 100. Okay, sorry. Yeah.
Your cost stops at age 100 regardless. Your benefit stays until you collect.
Okay.
But what I recommend, if at all affordable for the consumer, is pay over a shorter period of time, which is 25 years, right? If allowed. So for some ages, they won't allow it, but for the younger ages, most definitely. You see, the issue with paying shorter is that you have less opportunity for increases in your premiums.
Okay.
Yes. So in speaking to a couple of the providers, the product providers out there, one of them has never raised their rates. Right? Never raised their rates. The other one, it's a newer product, so no, they haven't, but that's a shorter time frame. What's important to know about the qualification and what triggers, one of the biggest triggers for them reviewing their rates is experience. What is the experience of their block of long-term care policies, right? Do we have a lot of people on claim, right? And if so, how do we make sure we pay for it? If we're unable to pay for it, then premiums will rise, they will increase. But if all's well, they keep them the same. At least one of the insurers out there, they self-insure, so they don't go to what is called a reinsurer or a retrocessionaire to spread out the risk. They keep all of the risk themselves, right? Which is a good thing for the consumer.
Does it show financial health for the company then if they're able to do that?
Yes. Well, I'll tell you this about all insurance companies that operate in Canada and Ontario. They're well regulated. They have to have money in reserves to pay claims. So money that is not put at risk into any sort of risky investments, etc. No, they're well regulated and must show proof that they have money available to pay claims. After all, the definition of insurance companies, they're there to pay claims.
Yeah, no, exactly. I usually take questions towards the end, but I do have someone asking a question that kind of fits in nicely right here. Elizabeth Brigg wants to know, should you check with your work benefits first to help determine what kind of plan you need?
Yes. Yes. So work benefits, they may or may not cover long-term care. Most of the workplaces will cover long-term disability. Don't get them twisted. Long-term disability will pay you until you retire if you were to be so disabled until you retire. So we're talking 65 here, right? Then the government program will take over. You go into pension, CPP, OS, and away you go. Long-term care is very different. Not all companies offer long-term care insurance to their employees.
Wow. So check your work policy and don't get twisted between long-term disability and long-term care is the takeaway. Make sure you understand that there's a difference, because I mean, I would have thought it would be, because it has the word long-term.
Right.
Would probably, naturally most people, if you're not educated in that field, you would think you're covered. You
may think, yes, I've got everything, I am fine, but find out that you don't. If your company has a long-term care program as part of your plan, you will want to find out if you're able to take that policy with you when you leave the company, either by leaving voluntarily, being fired, or you retire. Are you able to take it with you?
Yeah, that's important, because otherwise you've been paying into something that could just disappear.
Yeah.
Right.
Yeah.
Wow.
Yeah, you may find out that that plan only stops when you stop
Right,
working for
right.
the company, and then it's kind of useless because you really need it after you retire and as you become unable through age.
In preparation for someone meeting with you, if they have benefits at work, is it advisable then to kind of get a copy of your benefits package so you can review it as part of your consultation? Because most of us probably don't understand all that fine print and you're used to doing it, so you would know where to look and see what we have and what we don't have.
Yes, of course. I insist on it actually. Yes, as an advisor, I have to be able to do the best job for my client, and that means getting to know every piece of their financial life, as well as some of their non-financial goals and desires as well, right? Because it everything all of it speaks to how we're able to make you better, how we're able to make sure that you achieve the goals and successes that you want.
Mhm. So leading into that, how does one prepare for a meeting with you for a long-term care interview? What are some key pieces of information, I guess, that they should have on hand?
I ask my clients to gather any piece of information that they have. If you have an insurance policy, I want to see it. Don't be afraid. It doesn't mean that I'm going to tell you to do something weird and untoward with it. Not at all. Right? Any kind of insurance that you have, any kind of investments that you have, any money that you owe, right? Any other form of asset that you have. I want to see all of it because with that whole picture, then I am better able to say to make recommendations that are a fit for you. Okay. It takes time, right? You have to pack your patience when you're dealing with me, but I promise you that the outcome will be as you desire, and
Well,
even better than you desire sometimes.
yeah, no, I like that phrase, pack your patience. It's not a quick fix. It's something like you said, you want to be thorough and make sure that it's properly aligned with the person themselves. So anyone who does not want to do that, then they're probably not trying to not get you business, should go elsewhere because they're not looking for quality of service.
Yeah, well, I've seen a few things in my time,
I'm sure.
but I'm fortunate that my trusted clients
Yeah.
they they do what I ask, and it works. It works for both of us.
So does long-term care insurance pay family caregivers? So you
Yes.
don't have care coming in, but you have a family caregiver who decided this is what I'm dedicating myself to.
Okay. Yes, you can take your money and you can pay a family caregiver. Interesting fact that I read recently is that 75% of the care that is given in a home, a private home, a residence, is given by family members.
Mhm.
Yes, 75%. Pretty.
I I do believe that. I know of one client who I've encountered whose daughter got MS from a very young age, and she's now bedridden. The daughter. Now, the mother is in her 80s, the father's in her 80s, the daughter is now in her 50s, and the mother's still taking care of her.
Mhm.
Which also leads to, I think, long-term care insurance is good to have. If you have a family caregiver, there is something called caregiver burnout. So although you want to take care of your loved ones, if you're not good for yourself, you may end up in the same position as them, needing
Yeah,
care. So it's still a good idea, I think, we want to, but it's good to have that resource there if we need it as well.
of course. Well, I think of, in addition to that, if my family were to be taking care of me full time and they they're going to get burnt out at some point in time. Let's face the facts. I'm not an easy guy to live with. They need a vacation. They need to go away. I still need care, so I can hire care so that they can go on vacation. I could pay for their vacation, right?
Yeah,
Yes, yes. Go rest up so you can live with me a little bit longer.
yeah, yeah. So can you be like, what is there anything that long-term insurance will not cover at any point? at any point? Is there some absolute hard no's we won't? Because somebody would say born with a disability of some sort.
Yeah.
Is it something that, okay, you're born this way? Will they look and say no? Like, is there any point?
There are quite a few. There are quite a few. So your client, the child, would not be covered. Okay. People who have stroke, for example, not born with it, but they have it, and you could have a stroke at pretty much any age. No. There are several ailments that once they come across the radar, we have to look elsewhere. Okay. We just have to. That's why the companies came up with simplified issue that may um, exclude lesser conditions or do, right? So it is unfortunate, but the companies are taking on the risk and they're saying that this is what we cannot afford to cover, right? So
I have a question just popped into my mind.
Sure.
So with all the genetic testing and whatnot that can be done nowadays, if there's a parent who does this and they find out that their child will be born with ABC, can they get long-term insurance on an unborn child to cover this disability? That's a weird question. It might seem odd, but my mind kind of moves like that. I just thought about this. I'm like, well,
okay, that it is a good question. The insurance companies, they ask that you don't tell them about genetic testing.
Okay.
Don't tell them anything about it. They don't care. They don't want to know. And if you were asking me the same question about covering an unborn child for life insurance, I would say yes, that is possible. That is definitely possible. All right. But for long-term care, no. Because as I mentioned earlier, age 16 is your minimum age.
Yes. Okay.
Right?
So that clause negates that. That's absolutely. Just my creative mind going, okay, well,
sure. Let's
coordinate this. Okay.
Yeah.
Okay. Makes sense. Definitely. What is the best long-term care insurance? And in that as well, how does one go about choosing a company or choosing, I guess, using someone like you work with several different companies, or just what is the best way of arriving at a company and a solution?
Okay. Well, yeah. So you tell me what you need, I'll provide it. I'll find it. I'll tell you if it's available. Okay. So researching a company on your own, no. So here's what I have to tell you and the audience this evening, that up to 2018, about late 2018, I don't think 2019, but up to then, most of the carriers or providers of long-term care, insurance companies I'm talking about, actually canceled their products. Yes, they canceled their products, unfortunately. But, you know, when I was a product developer, and I can't speak for how hard their product the developers fought to keep their products, but I fought like really hard to keep my products on the books, even during times of low sales. But back to the story at hand, most of them, the big names, Manulife, RBC, Desjardins, all got rid of their products. So right now we have two big carriers in the industry. Two.
Yeah.
One is Sun Life, the other one is Ontario Blue Cross, that still have a long-term care product. Choice is limited, extremely limited. The worst part of it is that the reason they gave was because of low sales. People weren't buying it.
Not enough demand. Wow.
Not enough demand. So if I may take you into the underbelly of the insurance company just a little bit, just a tad, indulge me. When you have a product on your books, on your shelf, and it's not selling, you've already invested a bunch of fixed and variable costs, but especially your fixed costs, they're sunk, they're gone, not coming back. In order for you to upgrade that product, it's going to cost you a bunch more money, right? So at that point in time, as a product developer, you're going to have to make a decision. Do I keep the product as is? Don't change it. Don't do anything. Leave it. Right? Let it go stale. But I have it. Or do I get rid of it? Because the last thing you're going to want to do is to spend a whole bunch more money upgrading the product when there's just no sales. Okay. So yeah, this was it. And I will I'll put some blame on myself and other advisors who we don't talk enough about this product, right? We don't talk enough about its worth, its value to the consumer. So I'm not going to blame just the companies. No, we deserve some of the blame here too, right?
So is long-term care insurance worth it? And I think we already know the answer, but just directly put, is it worth it?
Yes, it is. Absolutely. 100%. Yes, it is. Buy a little bit, buy a lot, buy something.
Wow. Just get something.
Yes.
And do you begin when deciding with what you can afford to spend monthly, or do you begin with the coverage that you would like to have so you can age gracefully and with a peace of mind?
I think you start with a plan. Yes, you start with a holistic plan. But when you get to that specific point where you try to figure out, well, what can I afford to pay for long-term care insurance? That's when the type of product will come into play, right? And how much? Do you want $2,300 a week? That's fine, but if your budget won't get there, how about we do a reimbursement plan? Because at least you will have something.
Just as an idea, you gave us an idea of how low you can start. Someone wants the Cadillac of long-term care insurance, like top it up, just take it up, unlimited. I want to be covered no matter what happens until, with the, when you pass away, you can, put it on, get the reimbursement. What sort of monthly fee are you looking at?
For the Cadillac.
Healthy person in their 40-somethings, I'm talking about starting from the, ideal age. Yeah.
Can I share my screen? I'd like to answer your question.
I can give you access to do that.
Okay, let me see if I can bring up a little handy dandy PowerPoint. Okay. Okay, where am I? Okay. You can still see me, right?
Yes, I can.
Okay. Can you see that now? That screen?
Yes, I can.
Okay, perfect.
And just before you start, to all our viewers, if you are watching this and it looks a little bit funny, if you click at the top right where it says view options, zoom ratio, you can adjust the zoom ratio there. Usually fit to window will work. Go ahead.
Yeah, thank you. So one of the things that I love to do, it was necessary when I was developing product, was to do comparisons to see where my products stacked up. And I would use random ages, random sets of ages, etc. I did sort of a similar thing here, right? Unfortunately, I didn't do the exact scenario that you just painted, but this should give you some sort of an idea, I hope. So here we have a male 45, male 55, male 65. And I should mention that in long-term care, in pricing long-term care, the developers don't really look at smoking status. They look at male, female. Females, as they age, tend to become more expensive because they live longer and become more unable. Men, as I mentioned before, simply die. So here's a male 45, 90-day waiting period, $150 a month, unlimited benefit, annual inflation rider, return of premium at death. So didn't start with a whole lot of benefit, but got the whole Cadillac. And his monthly cost is $59.46. The same male with the same benefit, but age 55, 111, and at age 65, same benefit, 333. Okay, so here comes the second one. So a female now. Females 47, 57, 67. And there's a special reason why I started at 47, but
I can see why. Okay, go on. It's a mortgage.
Yes.
Go on.
So 90-day wait again, $1,000, not $150, but $1,000 weekly benefit. Right? This time we didn't go unlimited. We stopped at 250 weeks. So maximum of $250,000 of benefit at your control for a monthly cost of $154.
But that's without the death reimbursement or
That is correct. No return of premium at death.
Yeah.
Yes. But yes, and no inflation either.
No inflation. That's what I'm looking at.
No
Exactly.
inflation either.
Right.
I can tell you that for the female 47, if you were to add the two, the inflation and the return of premium at death,
Right.
that premium doubles.
Whew. Okay.
Yes, it doubles. Okay. Remember what I said about females?
Yeah.
Yeah, that's why. So at age 57, $290 a month, and age 67, $666 a month. And remember too, $1,000 a week, right? That's $52,000 a year, $450,000 of lifetime benefit. The third, I have 4 slides, and I'll get through them quickly.
Oh, this is great. This is awesome.
The last 2 slides, I quoted reimbursement plans.
Okay.
Okay, so this reimbursement plan is for males 55, 65, and 75. 0-day wait. You don't wait once you're hospitalized and you've lost your autonomy. Right, $100,000 maximum benefit in reimbursement. And for the 55-year-old, it's $60. For the 65-year-old, it's $61. And for the 75-year-old, it's $108. So you see that big difference, that big drop in premium in cost, right? For females, same benefit. 55 is $72, 65, $75, and for 75, $140. Okay, what this tells you is that this thing can be made affordable, right? If you want the Cadillac, I call it, of product, start young, right? Buy it young and buy what you want. Make sure you're healthy. As we age, though, it's going to become more and more expensive the longer you wait.
So can you start, say, then at 45 and then say, 45, your kids are off to university, your responsibilities are a little bit less, and at 50, scale up from a certain amount to an unlimited plan and get higher? Is it scalable in that manner as well? Well, you said though, if you're on a 25-year plan, you can't do that because it's fixed, right? Or
25 pays.
25 pays.
Payments.
Yes.
But in terms of the benefit, if you're willing to provide the company with additional evidence of insurability, then the company will absolutely look to upgrade you. They will, right? The key is you have to show evidence of insurability, because what you're doing by asking for that upgrade is that you're increasing the risk to the company.
They may
Okay.
want to know why. So they want to know what's going on that made you prompt you to do that decision. Right.
This is one of the times that I will tell you that they definitely will want to know why.
Yes, yes, yes. I understand that fully well. Well, thank you for having that. That definitely, I mean, some people can learn by, we all have different ways of learning. So by hearing, definitely by seeing is one of them. So you've given us both of those. Are you finished sharing the screen?
I am.
Okay, great. So I will, there we go.
Well, there we go.
Thank you. Off it. Great. You know what? This has been a remarkable discussion. Like I said, eye-opening for me, definitely. And it's been so frank. It's been so unscripted. It's been just flowing, and a lot of questions were answered. I know there's a lot more, but at least it opens the doorway for someone to feel comfortable enough now to come in with some bit of knowledge in a conversation like this with someone like yourself. What advice would you give to young people who are out considering a career in financial services or insurance? Just coming a little bit off topic, but what advice would you give to them?
I love the industry. I believe that you have to be well prepared to take on the industry. I say, be well trained. It's not that extremely difficult to get a license. You can get your license, but knowing how to navigate the space, how to help your clients in a deep, rich, and meaningful way is critical. So you have to be a learner. You have to dedicate your time to learning so that you can impart the right knowledge to your clients. It is a career. It is a lifelong career. Once you're in, try not to think too much about getting out, because your clients become your friends become your clients, and that's why you just can't quit. You
Relationship.
just, yes. So it's a great career. It's a wonderful place to work, and if you love people and love helping people to become successful, this is for you.
Times are rough right now, especially during the pandemic. A lot of people, there's a lot of job loss, a lot of loss of income, maybe, husband loss, wife loss, a lot of loss of income. What advice would you give to those now who are listening to this conversation today, knowing the right thing to do is to get some type of insurance because they don't have anything, but finances are tight?
Think about what you insure and why you need to insure it, and include yourself. If you own a home, you have to have fire and theft insurance. If you have a car, you must insure that car. None of these produce income. The only one that produces income is you. So think about insuring the income producer, which is you. And when you look at it from that perspective, you're going to prioritize, you should prioritize what's most important, which is ensuring your income potential, your human life value. Okay? Because without you, there's no it.
Mm. Mm-hmm. Mm-hmm. You're your best asset.
Absolutely. And in terms of the types of insurance, there are plenty, right? You don't have to start with the Cadillac. Start with something much more humble, and then upgrade. As your circumstances change, you're allowed to upgrade. And a lot of times without providing any additional evidence of insurability. Take advantage of some of the neat features in these contracts. Okay.
Mm-hmm.
Yeah.
Is the contract something someone should have a lawyer look over? Is that necessary? Like, what is it usually required? There's like a cooling off period when signing up. This is a question that just came to me.
Sure thing. So I'll start with the cooling off period. Uh, Most contracts out there have a 10-day free look, meaning you can have it for 10 days and return it and say, I want my money back. I don't want the policy. That's fine. In terms of having your lawyer review the contract, if you feel so inclined, I personally wouldn't feel the need to do so. Insurance companies have legal departments that write the standard. There's the standard general provisions of the contract that are written by lawyers and the marketing department as well. I used to do some of that work. But then the rest of the contract is actually pertinent to you. So the front pages of the contract are what we call the data pages. That has your information on there. Okay, Desiree bought $200,000 worth of insurance. Here's her age. Here's she's female. Right here are the guaranteed and non-guaranteed parts of the contract. That's all pertinent to you. And then on the back end of that contract, you'll find your application form. So what you wrote and said, I have that, I don't have this, that's there. That all forms your policy. So yes, if you feel like that is something that will give you peace of mind, do it. But it's the same for everybody who bought that particular policy, that particular iteration of the policy.
Okay, got it. And I know we've been on for almost an hour. We're almost done, but this has been like, really, it doesn't even feel that long because it's such an engaging conversation. I had a question that just came to the top of my head and it slipped away. It's okay. That's all right. It was a good one too, because I'm here thinking as you're speaking and I'm going, okay. Oh, so when you have the one where it's at death, where you can get some of it back, what percentage is that? Or is it depends on the policy as well?
Yes, it does depend on which brand of policy you bought. So one goes up to 80% return of premium at death, the other one 100%. Okay, yeah. Then the return of premium at death is insurance on the insurance, as you can imagine. So you're paying for that insurance to make sure that you get your insurance premiums back.
Right.
The lesser premium you get back, you agree to take back once you're dead, then the less expensive the policy is. So that's why it works that way.
Right. No, that only makes sense, definitely. It can be looked at as a saving plan as well. If you remain healthy until you pass, then it's a good thing that you can will it to somebody, right?
Absolutely.
My question that I had, is it transferable between spouses? No, beyond the individual. So I have insurance, say unlimited. My spouse has a little bit of insurance or whatever. Can I activate mine to transfer it to him? No.
Well, the claim,
yes,
the claim is dependent on the insured. Okay, so if you qualify, if you are unable and you qualify for the benefit, well, you'll get the benefit. Well, you can give your husband some. That's very generous of you. He has to qualify for that claim on his own as well. Now, here's an interesting tidbit. If you and your husband are both insured, you become unable and you qualify for that claim, the insurance company will waive your ongoing premiums. Okay, so they won't charge you and then give you the benefit. They'll say no charge, we're waiving that cost, but they'll pay you the benefit. Not only will they do that, but they will also stop charging your husband.
Okay.
Yeah, so they'll waive his costs as well.
If you're with the same company.
Yeah.
Okay.
Yes.
Right.
Absolutely. Wow. That's how they'll know. So yes, they will waive both. Right. Although he's not on claim, he doesn't have to pay because the premise is that he's going to be the one providing substantial care for you. Right.
Good to know. Yeah. I have an anonymous attendee with a question. can't get over the fact that as your income earning ability decreases, your cost rapidly increases. How do you solve this? Get a good side hustle that pays you money. Get that, what's it called again? Yeah, as your income decreases, you know, your cost rapidly increases. How do you solve this?
I'm not sure what
Residual income.
the cost of insurance. Yeah.
Yes.
Okay. I think I understand the question.
Yeah.
Well, the as we age, we either present either way we present a higher risk or greater risk to an insurer. And so when we grow older, if we don't die, we die a little, meaning we get sick, right? So when you're young, it's unfortunate if you die, just up and die. Very unfortunate. But as you get older, the risk of dying becomes more clear. However, we've been living longer. We've been living a whole lot longer. I think just about now, life expectancy is starting to peter out a bit. That people have kind of longevity is kind of slowing down now, right? But you think about it from an insurer's perspective, they have to make sure that they collect enough premiums and invest it for whatever time they think you have left on this earth in order to pay that benefit, right? It's not a magic thing. It's a real thing that happens. So add to that regulation that says you must reserve a significant portion of the premiums you take in order to pay claims, then that leaves the lesser amount to invest to pay the benefit. It's a dilemma, but if you plan well enough, if you get a good head start, and this, by the way, this is not judgment or blame. If you get a good head start, you get a nice wind of good luck in your sale, then you will be able to plan so that you actually have the opposite problem when we get older. Okay, when we think about intergenerational wealth, you asked one of the questions about the wealth, the folks who are wealthy. A lot of our wealthy folks in this society have intergenerational wealth. So their wealth didn't come just from their hands alone, it came from their foreparents' hands. Some of us, unfortunately, don't have that. It's very unfortunate. But as little as we have, we must, and I encourage us to think about the next generation, making sure that they have a little bit more and a little bit more and a little bit more. And hopefully one day they will be in a position where they can say, you know what, we're okay. It's fine. We have a tax problem as opposed to a poverty problem.
And that even gets into, I mean, this is more on the financial planning side, but really looking at ways to have a residual income so that, yes, you're retired, but there's still, if you're able to still have money coming in even at that point as well.
Yeah, if you can, absolutely. Like I said, I know some people who they've aged out. Time is not on their side anymore, and it is pretty unfortunate. I've had the displeasure of seeing clients run out of money before they end of life. They're very much alive, but they've run out of money.
Right.
Yeah.
Wow. Wow. So we've discussed so much, and what are, I guess, 3 key takeaways that you would want our listeners now and going forward? Because this is going to be, you know, we're doing the podcast, this is all over. What are 3 key takeaways do you want our listeners to have?
So I usually say plan, 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 execute, execute, right? So plan 3 times, execute twice. It's get a plan, first of all. Make a plan. Don't wait for your income in order to make a plan. Start planning. Okay? Work with a professional. Work with somebody who cares. Work with somebody who's honest, who's going to tell you the truth, whether or not it hurts. Okay. And lastly, be dedicated to your own success.
Mhm.
Yes. Don't be afraid to be a learner, right? Seek the help that you need because it's going to help you. Those are the three things that I have to say.
All valid points, not just for insurance. Life advice you're giving us as well. You're sharing that knowledge with us. Definitely. Now, I can't conclude this interview without touching on this dragon boat racing thing. Accomplishments. I gotta go there just really quick. I know time is running, but I gotta go there. So what prompted you to not only try dragon boat racing, but to join a national team and do this at such a high level?
Wow. Yeah, so it started when let me go back to childhood. I come from a family of fishermen. My grandfathers were fishermen, my uncles fishermen, just fishermen. I grew up near the sea, but I didn't think anything of it. It's just the sea, right? It's what you know. And several years ago, 2011 or so, one of my cousins, his wife, is a nurse. She invited me to join her hospital dragon boat team. I said yes. I joined. She didn't.
Okay.
And I took to liking the sport. You see, for me, the water represents calm. It represents tranquility, right? It's a space where I can just let go of all troubles, all stress, and just work at being my best me. Whether I'm by myself on a boat or on a team with another 19 or 20 people in the boat, I can feel the impact of every stroke I take, every move I make or don't take. So it is to me, it's very, it's a truth that happens when I'm on that water.
Right.
So I joined that team and worked with them for a couple of years. Then a group of firefighters came along and said, "Hey, do you want to join our team?" I said, I said, okay. They were pretty fun guys. So I joined their team and worked with them for a couple of years until I realized that I was starting to get ambitious. I'm like, I think I need more competition. So I joined another team, but this time with a national coach.
Oh,
Yes. And I remember joining the team, and the first year I said to him, I think I'd like to try out for the national team. He said to me, well, you're welcome to try. I don't know if you'll make it, but no harm in trying. Well, you can never tell me stuff like that because you know I'm going to make it.
yeah.
Yes. So I dedicated myself to working and training very, very hard, 6 days a week, all kinds of from yoga all the way to the different exercises, right? Strength training, you name it.
Right.
Eating, nutrition. It was about it was about that, right? And so I tried out. They invited me to the next training camp. I said okay. I went. Then they invited me to try out for the next training camp. I did that, and I kept going and going until finally they said, "You're on the team, man." I said,
Wow.
"Well, there you go." so, so after China, I went, and it was a phenomenal experience. Yes, China is big. China, to me, is a beautiful space on this earth, and their hospitality was second to none.
Wow.
Yeah. It was a very proud moment for me to stand on the podium because my first gold medal was the first race of the entire tournament.
Wow.
Everybody was watching.
Oh, wow. Yeah.
Everybody. You talk
Yeah.
about being on the spotlight, under the spotlight. We were on the spotlight,
Nice.
and yeah, we started It was a 2,000-meter race, so 2-kilometer race. We
Right.
started last. Okay, so yes, we started last, and we surpassed everybody to win. I still feel a rush
When
right
you
now.
talk about it, yeah, I can
Yeah,
imagine.
yeah.
Wow. Wow. Well, we've gotten to know you so much better, and we've learned a lot of information, like I said, filled with so much valuable content. And it's great that this is recorded, because if someone missed it, they can hear it again, they can rewind, they can pause. When I watch recorded content, if it's an hour, it takes me about 3 hours to watch, because I'm a note taker. So I'm busy, stop, rewind, pause, so my family gets sick of hearing the same thing over and over again. But that's how involved I get when I listen to something. So hopefully our viewers will do that. My last question for you is, if any of our viewers want to contact you, how can they do so?
Okay, so I'm a very reachable kind of guy. Call me or email me or text me. My number is 416-727-9056. So again, 416-727-9056. Or you can email me at owen@owenrhoden.com. That's how you can reach me.
All right, great. So Owen, again, thank you so much for taking the time to be on the show, to impart your knowledge on us, and to just share some of yourself with us, because like I said, we really got to know you. So thank you very, very much. So our next show will be the 411, as I was discussing with you, on funeral pre-planning. This is a sensitive and often difficult topic to have. However, death is a fact of life, and I felt the need to delve further into this topic. So I'm asking my viewers to join me on Sunday, April the 18th, as my special guest, Manel Williams from the New Haven Funeral Center, and I will be discussing the 411 on funeral pre-planning. I want to thank everyone for joining us tonight, and remember that all our discussions can be found on YouTube, on the Senior Living 411 Incorporated channel, or the Senior Living 411 podcast. With that being said, have a good night, everyone, and stay safe, and check out your insurance as well. Thank
Thank you,
you.
Desiree.